Hello, everyone. So this is the last video of chapter 13. This chapter is challenging, I understand it. And some accounting treatment, accounting treatments are very complicated and challenging. So to complete this chapter, you need to spend more time to practice, do your homework. Okay, so this video will show you how to accounting for investments in equity securities. As we discussed, investment is companies want to make money by spending excessive cash or fund. So the first equity security is the motivation is to arbitrage the stock price, sell at a high price and buy in the low price. And so this kind of equity security is called, let me see, show you, at fair value, because the intent of the investor is just to arbitrage the stock price. They have no intent to have a significant influence or control for the invested company. So this kind of equity security will report it as fair value. So usually recorded at a cost, and then remember three procedures. The acquirement date recorded at a cost, and on the reported date, usually December 31st, we need to report the fair value on the balance sheet. And if the fair value is different from the recorded cost, we need to adjust it. And we have unrealized holding gains and losses. So because the intent of this security is to arbitrage stock price, so the fair value has a very active marketing. So, I mean, the fair value has limited risk, limited uncertainty. So these unrealized holding gains and losses will be included in the net income, going to the income statement, included in the net income each period. And then we will identify dividends income, and also realize the gains and losses after sales. So let's see some examples for this marketing equity security. The example is on May 1st, 2019, the company purchased the following securities. It's just for arbitrage the price. And we record this all of these assets, all of these securities at the transaction cost. And then it's considered a minority passive influence. So as we just in, so the security is just for arbitrage the price and make money. So at this time, the total cost is $53,000. 100 times 50, 300 times 40, and 200 times 20, 120, 120, and then the result is 43,000. So debit investment in equity security, credit cash. And then at the end of the 2019, the company received the dividends. So companies are not obligated to pay dividends on equity security, but dividend income is recorded when dividends are declared by the company's board of directors. So on this date, according to accrued basis, we need to record this the right to receive the income, the dividend income. So after we receive the cash, debit the cash, credit the dividend income. So if the dividends had not declared at year end, but the prior had not yet received them, has been declared but didn't receive, the debit dividends receivable, debit dividends receivable, credit dividends dividend income. So that's dividend income. And then we need to recognition of the unrealized holding gains and losses on the reporting date. As we know, fair value for the as a measurement instrument for the long-term securities assets, because the company will hold these assets for several years. So at the end of each year, we need to recognize the difference between the fair value and the balance of the account. I mean the book value. So the difference will create unrealized holding gains and losses. So on its balance sheet, a company reports any investment in equity security for which it does not obtain significant influence or control. And then this fair value equity investment change, I mean, the unrealized holding gains and losses go into income statement as a one part of net income. So a company need to report both realized and unrealized gains and losses for the minority passive securities. I mean, for their security just for arbitraging stock price. So this is an example. On December 31st, 2019, the fair value of this the investment is $55,500, and at that time, the cost, the balance of the security is $53,000. So the fair value is higher than the initial cost, $2,500. So we recognize this unrealized gains. We debit investment in equity security to add this value into the balance of the security. And creditor unrealized holding against equity security. And this unrealized holding gains or losses is because it's a gain, so it will add the earnings, the net income. So on its December 31st, 2019, Pride will report the investment as an asset at $55,500 fair value, and at the same time, recognize the revenue, the gains in the interest income, in the income statement as $2,500. And in this process, maybe the fair value will decrease them, and I mean lower than the balance of the financial item, I mean for the securities. So at this time, for example, on December 31st, 2020, the fair value only has 52,000. So we need to recognize the 3,500 loss price decrease. And the generalization is opposite of the gains. You know, the gains is debit investment in equity security, credit unrealized gains and losses. So the loss will be debit unrealized holding gain or loss, credit investment in equity security. Okay, and then at the end of 2020, the fair value and the balance of the these securities is $52,000. And in the income statement, we need to show the 3,500 unrealized holding loss. Okay, so we need to the price change will impact the balance sheet number and also income statement item, financial item number, accounting number. Okay, and then it's stage 3. After sales, after selling the equity securities, we have realized the gains and losses. So this realized gains and losses, it's easy to compute. It's just the sales revenue. I mean, how much money, how much cash the sales get. This can come from these sales. And what's the balance of the investment equity security, and the difference is the loss or gains for this sale. It means realize the gains or losses. So in this case, it's on March 1st, 2021, Pratt sold 100 shares of the company for $6,000. The fair value was $6,100, but the cash the company received only $6,000. So this sale actually cost $100 loss. So the generalization is debit cash, debit loss on sales of on sale of equity security, credit investment in equity security. Okay, so that's easy. So this one is the balance on the sales day. What's the amount of the book value of the securities? So this cash is how much money you received, and the difference is loss. That means you sell your 6,100 assets in the price 6,000. So actually you lost 100 from the sale. Okay. And in this case, it's gain. I mean, the fair value for this security is 47,600. And and at that time, so it means on December 31st, the total fair value of the remaining is $47,600. And on December 31st, 2020 is only 45,900. So there is a difference, 1,700 increase of the fair value. But this is unrealized holding gain because the company still hold the investment. But we need to recognize the difference as an unrealized holding gain. So debit investment in equity security created unrealized holding gains equity security. And then that's this number will appear on the balance sheet on December 31st, 2021. So in general, for equity security, if the company do not want to have a significant influence on the invested company, we will use the fair value as the measurement instrument. And all of the unrealized or realized gains and losses and interest income are going to net income in the income statement. And for the data security, we already have a detailed discussion in the previous video. Okay. In summary, in conclusion, the summary of the accounting of marketable security is, first of all, financial accounting standard board requires all investments in equity security reported at the fair value at each reporting date. With the changes in fair value in the balance sheet as an asset and in the net income in the income statement. As I just said, because the change, the value, the price change will impact the balance sheet and also income statement. So a company measures and reports investment in trading and available for sale date security at fair value. Also, that's for the date available for sale data security. We already have this detailed discussed in the previous section. So also for I think for this kind of summary, you can read the textbook and the slides to understand that, because I would like to speed up for the some more complicated content. So in this slide, we will have a detailed discussion about the minority but active investment. It means this investment is not only want to make money, but also it want to impact the invested company to influence the decision makings of the invested companies. So usually this kind of minority active investment has two criteria. One clear significant signal is the investment can have more than 20% of outstanding common stock of the invested company. If you own more than 20% of the common stocks, that means you have a right to impact the decision making of the invested company. Or you have a representative on the board of directors, or you can the investor can participate in the policy making process, or some transactions will significantly impact the invested company. For example, all of the materials will come from this the investors. The investors' materials will dominate the invested companies or operations. So in this situation is also significant influence or technological dependence, or can assign some managers into the invested company. So whatever the factor is, if a company can significantly exert a significant influence of the invested company, that in this situation, the investment will use equity method to measure. So we will use equity method to measure this kind of investment. So in general, the equity method is used to account for investments in which significant influence exists. And so to recognize this investment, we have three procedures. In the first procedure is recognize the initially cost. So how much money spent on this investment. And then we need to record income and an increase in the carry value of the investment account when income is reported by the investee. That means, for example, you invested $1 million to have 20% ownership. And then if the invested company make a lot of money in this period, okay, I think we'll use the next video for this method, because a little bit of noisy happened over here. So see you again